So today we're going to be answering the question of how much do you actually need invested to live off dividends in Australia? Now, the reason for this is I essentially had a friend come up to me last week and he essentially told me he wanted to get to a place where he essentially didn't have to work anymore. And I was like, well, wouldn't we all? Well, my next question to him was essentially asking him how much money on a yearly basis he thought he would need to be comfortable with his life. And he told me he'd like around about $4,000 a month in spending money. So that equates to $48,000 a year. Now, depending on who you are, you might need a little bit less or a little bit more depending on your lifestyle. But I think for the general Australian out there, $48,000 a year seems about right. So in this video, we're going to go over the math and figure out how much you actually need invested to live off dividends. We'll also talk about considerations you'll need to make if you are looking to focus on dividend investing, why dividend investing shouldn't be your only strategy, and then also some tax considerations that you'll need to make as well. So make sure you hit that like button, subscribe to the channel, and let's get on to part one of the video, which is the math. So let's say you wanted $48,000 in dividends per year. Well, that really depends on what we're invested in and the dividend yield or the payout ratio of our total investment portfolio. All right, so let me give you an example. Let's say you invested into Telstra, and in 2022, Telstra paid a dividend of 16.5 cents per share. That means if you owned a single share of Telstra, which hovers around about $3.90 per share, you'd be earning 16.5 cents passively each and every year. Now, the dividend yield is simply the 16.5 cents divided by the stock price. So let's assume $3.90 as an example. So it would be 16.5 cents divided by $3.90, which is around about 4.2%, which this would be our dividend yield. Now, this percentage is the number that you want to focus on because it's essentially telling us for every $100 that we have invested, how much as a percentage we're getting back in terms of passive income. So if you had $100 invested into Telstra, you should be roughly getting back $4.20 every single year in passive income. Now, if you wanted to receive $48,000 a year in passive dividend income from Telstra, you can see where this might become a problem because you need quite a significant amount invested into Telstra to get to that $48,000. Assuming that Telstra will continue paying out the dividend yield of 16.5 cents for the foreseeable future, let's divide the 48,000 by the 16.5 cents, which gives us a little over 290,000, which is the number of shares of Telstra you need to have in order to receive $48,000 in dividend income each year. Then let's multiply that by the average share price of $3.90, which brings us to the total amount that we would need to have invested into Telstra, which is just over $1.1 million. Now, you might be wondering to yourself, Raymond, why don't we just invest into a higher dividend paying stock? And you're right, we could invest into Fortescue Metals, which has a dividend yield of around about 13%, in which case you would only really need $540,000 invested into Fortescue Metals to receive the $48,000 in dividend income each year. So you can really see how big of a driver the dividend yield is to figuring out how much you actually need invested to live off dividends for the rest of your life. Now, in reality, you're very unlikely to be completely invested into one single dividend paying stock. Instead, you're going to have a well-diversified portfolio, which has a range of different dividend ETFs or dividend paying stocks making up your whole portfolio. And I'd say that the average dividend yield of a well-diversified portfolio is around about 4 to 6% in Australia. So in reality, this means you're going to need around about $1 to $1.5 million invested to receive $48,000 in dividends per year. Now, this leads me into part two of the video. If you are going to go down the route of dividend investing, then these are 3 rules that you need to follow to ensure that you're successful. The first rule is that you shouldn't go out and chase dividend yields. One of the things that all dividend investors will look for when they're deciding whether or not to invest into a dividend paying stock is what the dividend yield of that stock is. The higher the yield, the higher the return, but numbers can be deceptive. If the stock's dividend yield isn't sustainable over the long term, then those dividend yields can dry up in the future, and this can have a negative impact on the stock price, and we call these stocks dividend yield traps. AGL is a classic example of a dividend yield trap. Last year, they were paying a dividend yield of 10.6%, which would have had dividend investors salivating at the mouth, but this year they've cut the dividend yield to 3.6%. And on top of that, the stock price has been steadily declining as well. When companies pay out above average dividend yields, you should always take it as a grain of salt because it could mean that there's some issues going on within the company itself. The second rule to be mindful of is the payout ratio. A company's dividend payout ratio can reveal how safe that investment is. A company's dividend payout ratio is the total amount of dividends paid out to shareholders relative to the net income of the company. This ratio not only tells investors how much is being paid out to shareholders, but how much income the company is retaining. If you come across a high yield dividend stock, but the company is paying out a substantial amount of its income to shareholders in terms of dividends, then you should take this as a sign to tread quite cautiously. If the company were to see its income stream reduced in the future, then you'd best bet that the amount of dividends that you receive in the future as well would be reduced as well. The last rule is that when building a dividend portfolio, you should try to stick with well-established dividend-paying stocks. The stock market moves in cycles and it has a tendency to repeat itself every now and then. When choosing dividend investments, there's no better measuring stick than a stock's past performance. For example, in America, they have companies that have earned a status known as dividend aristocrats. These are established companies that have increased their dividend payouts to investors consistently over the previous 25 years. Their brands are easily recognizable and they generate a steady flow of cash with a high likelihood of continuing to do so in the future. So this brings us to part 3 of the video, which is alternative strategies to dividend investing and why you should consider them. Now, depending on how young you are, it might be better to go down a different investing strategy. And based off of my YouTube analytics, 80% of you guys are below the age of 34. An alternative strategy to dividend investing is growth investing. And in my opinion, it's likely a better strategy to invest into growth whilst you're younger. And there's 3 main reasons. The first is that you can afford to take more risks when you're younger. So let's say, for example, you had $1,000 invested into a dividend paying stock with a dividend yield of 5%. Each year, you'd only be receiving $50 in passive income with not much else growth. That $50 is hardly going to be making a dent in your overall portfolio. I think it's much better to take that $1,000 and try to grow that capital as quickly as you can. Which leads me to my second reason, which is whilst you're young, you should be trying to maximize your capital gains and your capital as much as you can whilst you're younger because you can take on more risk. And lastly, the third one is compound interest. The earlier we get started with investing, the more time we have for compound interest to do its magic. So that means that the strategy should be that when we're younger, to try and build up our portfolio to a sizable figure as much as we can. And then as we're older, shift that to a more safe dividend paying portfolio. And this is because as we're older, our margin for error becomes smaller as well. Because we're nearing investment, we don't really want to be investing into risky penny stocks that could go bust. Rather, we should be investing into well-established companies that are highly profitable and pay out a consistent dividend income. This strategy can also be a much more tax efficient way of investing, which brings me to the final part of this video, which are the tax considerations to dividend investing. When investing into dividend paying stocks, you need to be aware that all the dividends that you receive will be taxed at your marginal tax rate. Even if you reinvested all of your dividends and you don't actually technically see any dividend income coming into your brokerage account, when tax time comes around, you'll still need to pay tax on the dividends that you receive. Which is why when we're younger, it can be quite tax inefficient to be investing into dividend paying stocks. Because during this time, presumably, this is going to be when we're at our highest earning potential. So we're going to be at our highest marginal tax rate. So you're going to be needing to pay even more taxes on the dividends that you receive. Whilst on the flip side, when we're nearing retirement or are actually retired, the amount of income that we'll have coming in will be significantly less. Meaning we'll need to be paying less tax on the income that we receive from those dividend paying stocks. Which means that the ATO gets less tax from you and you get to keep more money in your pocket. So let me know what you guys thought about the video down in the comment section down below. Are you guys dividend investors or are you growth investors? And how much would you need to live off dividends for the rest of your life? Hope you learned something new, and if you did, make sure to hit that like button, subscribe to the channel, and as always guys, I'll see you guys in the next video.